Welcome to Deal Playbook, the show where we decode the real strategies of leverage behind scaling, acquiring, and exiting. I'm Tom Shipley, and after building and selling 16 companies, generating over $2 billion in sales, raising hundreds of millions in capital, and leading through chaos and opportunity, I've learned one thing. Success doesn't come from playing harder, it comes from playing smarter. Every episode, we will break down tactical frameworks, investor insights, and mindset shifts that move you from deal hunter to deal architect. This is your insider's guide to creating exponential growth and wealth through leverage, capital, and connection. Welcome to Deal Playbook. Let's get to work.
Today's guest I'm very excited about. It's Callum Laing, an entrepreneur who has been involved in more than 100 M&A transactions and over 500 million in shareholder value creation. But what I'm about to share with you is even more exciting than that. But first, he built MBH Corporation to a global small business conglomerate, runs a $100 million regulated fund in Singapore, and leads Verblin Director Program for first-time board members. He's also the host of Callum Connects, a daily micro podcast that ranks in the top 5% worldwide. But why he's here today and really sets him apart is his public roll-up model, a completely different way for a small business to scale through acquisitions, leveraging of the public markets and creating exit and liquidity events for them. Callum, it's great to have you.
Yeah, it's great to be here, Tom. I'm really looking forward to this chat.
So what we're going to start with is I'm going to just jump into this because we had a call 2 weeks ago, which is fascinating to me. It's this new model that you created. And again, I'm not familiar with other people that are doing this. It's your public roll-up model that lets small businesses scale through acquisitions, access public market credibility, and do no cash deals at close, while finders were able to keep control and really control their destiny for the exit. I'm going to ask some questions about how you started this and what inspired this, but maybe let's start with explain this business model.
Yeah, so look, I think both myself and my business partner, Jeremy, come from a small business entrepreneurial background. And I think if you look at most M&A and capital markets, you don't have a lot of entrepreneurs there. You have a lot of finance people there. And so most acquisitions are done through the lens of a CFO and through a finance lens. And it's very much, look, if we acquire your company, we're smarter than you, and therefore you have to do things our way. And as entrepreneurs ourselves, we know entrepreneurs aren't very good at being told what to do, especially by accountants. And so that was kind of the genesis of the idea was, look, if we're going to do something like this, we want entrepreneurs to be at the heart of it and to keep control. And really what we were looking at was, if you think about sort of startup and tech and venture capital, it gets a massive amount of media coverage, but it's a tiny percentage of the world's economy. It gets disproportionate amount of coverage. Then you've got companies that are 200 million market cap and above, and that is kind of private equity, and it's really where the capital markets start to take off. What sits between those is 50% of the world's economy. Mm-hmm. So it's boring old economy, restaurants, accountants, just general small businesses. But it's the biggest asset class on the planet, and yet investors don't have any allocation to it because it's illiquid and it's risky. Small businesses have a habit of falling over. And so our philosophy or our theory was, okay, let's put together a group of these under a public holdco. And that gives investors access to basically a portfolio of small businesses. But rather than do the sort of traditional model of, okay, let's borrow some money, buy these companies, rebrand them, try and get them to conform to our model, we did it very bottom up. And we basically said to the companies, right, you swap your private stock for our public stock, and then you carry on running the business. You've already, it's already profitable. It's already, most of these businesses are doing $1 million plus of EBIT. Just keep doing what you're doing, like your brand, your hiring and firing, your culture. And you become a co-owner. So it's basically like a cooperative of small business owners. Mm-hmm. and you're a co-owner, so it's in your interests for the other businesses to do well, but you can't tell them how they should run their business, and they can't tell you how you should run your business. And so we structured it in a way that the more EBIT you contribute, and we focus on EBIT, not EBITDA. As you know, DA is where you can hide all the nasty stuff, but EBIT is closer to kind of cash flow. So we basically structured the model that you continue to earn equity in the company, in the holdco, the more profit you contribute to the group. So it's sort of a perpetual earn-in model. So if you have a bad year, you don't get penalized, but obviously you don't earn stock in the company that year. Whereas those companies that overperform do earn. So it's a very nice model that solves a real problem for small business owners, and it gives them a third option, which is, normally you're kind of stuck with, I'm stuck in this business forever, or I sell it. And if I sell it, I kind of lose my legacy, I lose control. Like, if I'm big enough to sell to private equity, I know that they're going to saddle my company with a bunch of debt and fire half my team that have been loyal to me for the last 20 years. And I don't want that. And so this kind of provided a third option. But it also offered business owners a couple of other things that I don't think we were even that aware of at the beginning. One of which was that as a public company, you can win much bigger contracts than you can as a small business. So procurement best practice is never to give a big contract to a small company. And so business owners kind of face this, we call it the scale paradox. You can't get big until you are big. It's like you can't win those big contracts. You can't attract the best staff to come and join you because you can't compete on a level playing field with other companies, with big companies. And so by joining a PLC, suddenly that unlocks access to bigger contracts. You can give stock options to staff. And you've got a currency to go and do your own acquisitions. So you can start acquiring suppliers and competitors and grow through acquisitions. So yeah, that was sort of the
it's
idea.
really interesting because I consider a lot of stock options that companies do, because who knows if they'll ever sell. And, I'm going to say that most businesses never sell. And therefore, it's like vaporware when they're given, but this is something really solid and tangible.
Yes, exactly. And they can look at the share price on their phone every day, and it's very real.
Amazing. So how does the mechanics work on that as far as, okay, so I come in and let's say, first of all, what is the average size business that you do, revenue and EBITDA, that you bring into a portfolio?
Yeah, so look, we now do sort of multiple ones of these all over the world. Generally, what we've found is a lot of it comes down to the equity story. And so, what is the story that we can share with the market if you're looking at sort of the pure agglomeration play, which is what we call this model. Ideally, we're looking for companies that are doing at least $1 million of EBIT. So 1 to 5 million of EBIT is sort of the sweet spot. They're too small for private equity, or hopefully too sensible for private equity. But they're big enough that ideally they've got a CFO in place rather than an account manager or a sort of an office manager. And while we always sort of pitch, look, the beauty of this model is that it's your culture, it's your way of doing things. Nothing needs to change. The one thing that does need to change for most companies is the financial reporting in the PLC world.
Public scrutiny.
Becomes quite important. But actually, just from I know you're very international and based in Tel Aviv. One of the other things that we learned through trial and error, and by the way, we've been doing this for 10 years and have made every possible mistake going along the way and learned a lot of very expensive lessons. But one of the things that obviously, people get very excited about the US as, that's the US markets are bigger than the rest of the world combined. But there's a lot of challenges in the US, and it's incredibly expensive. So just recently, we had to do some filings on a US public company. It cost about $95,000 to file a couple of pieces of paper. That same filing in the UK is about 5,000 euros, and on Frankfurt is about 2,000 euros. And so, there's what we realized quite early on was companies are quite good at thinking globally in terms of their clients or even their staff or their suppliers. But when it comes to listing, they always tend to focus on their local market. And actually, that doesn't always make the most sense. And now we've got quite a few American companies coming to us. We list them in Europe, help them grow through acquisition to the point where they can kind of get to a billion market cap. And then we can cross list back into the US when they're big enough and ugly enough to sort of fight their own battles, because it's very expensive in the US and it's very litigious. And there's a whole bunch of hedge funds and other people that enjoy beating up small companies on the public markets, and so you can build sort of safely in Europe, for example, and then cross list later when you need the liquidity.
So I want to boil this down to really some basics okay, so I have a business that does, let's just keep the math simple, $1 million in EBIT. Okay. So I'm coming in and I'm, let's say, the first member of a group. Okay. And you have other ones that are already pipeline. So, what is my company value? How do you issue stock? How does that actually work?
The first one's a little bit different because you're kind of taking the bigger risk, and so we'll try and make that as attractive as possible. But generally what we've done in the past is we have a standardized model. And so we're very, very open and transparent with everyone. This isn't an exit, it's a growth strategy. But the way that we've done it in the past is anyone that comes in will get 3 times their last year's EBIT plus whatever's on the balance sheet in stock. So if it's $1 million EBIT, they might end up with 4 or 5 million of stock on day one. Every year thereafter, the incremental profit that they contribute to the group, they get 3 times that. So if the following year you did 1.25 million in EBIT, that 250, we would times that by 3 and give you another 750K in stock. So you're constantly building it, and that stock is locked up as well. So you're sort of in this rolling lockup scenario. And then obviously every other company that comes in is on the same model. What we found is that was a really good model for keeping everyone on a level playing field. So everybody knows what everybody else is getting. You don't have any of that sort of, well, did you negotiate a better deal than me? And the whole idea is this sort of cooperative sort of feel. And so that model worked very, very well for that group. And it can be incredibly lucrative as well. You have to, if the value of the stock is going up consistently because you're adding revenue, you're adding EBIT every single year, then it's a very attractive model, and companies want to get in sooner rather than later, which is nice.
And then what is, give me an idea as far as what you're saying your platforms typically trade for by year 3, because basically I'm, coming in, I'm getting equity at a 3x, even though my value in public, if I sell my business, if I can sell, is probably 4 or 5 at $1 million or 2. So I'm coming in as a discount rate, but then, and I'm earning it every year, but then I have this stock. Now, what's the value of it in the public markets? You're seeing after 3 years.
Look, there's a couple of points. The first is this isn't an exit. And so contrasting this to an exit valuation. And actually, when we first started this 10 years ago, we did try and bring people in at sort of 6 or 7 times earnings because we were trading at 10 or 15 times.
Right.
But what happened was we had people treating it like an exit. And when you bring somebody in at 3 times earnings, they're clear, okay, this is a growth path. And I still have full operational control over my company in a way that I wouldn't if I sold it. Some of the lessons that we've learned along the way. So this model was designed and built very much from the ground up to solve the problem for small business owners, and it's done that very effectively. What we did in the first, took us quite a long time to learn, but first 7 years, is we just followed best practice on taking companies public. So we worked with investment banks, we put a ton of money into in investor relations, and we really focused on trying to get liquidity into the stock. And that's best practice advice for companies that go public is you want as much trade in your stock as possible because bigger investors can't come in unless they can see their way out. Mm-hmm. The problem with that is all based on what works for big companies. it doesn't work for small companies. Small companies it's incredibly easy to manipulate people's stock prices. Ultimately, we'd done this a few times, and what we were seeing was we're bringing these companies in, revenue's going up, EBIT's going up, dividends are going up, everything's great, but the share price was going down. And so we kind of looked at that, and it wasn't the founders selling, but oftentimes when you bring a company in that's 15, 20 years old, there's an ex-business partner or an ex-husband or an ex-wife that owns stock, and they're not bought into the long-term vision. So as soon as they became unlocked, they would just dump their stock in the market. And then what happens is you just constantly get caught into this cycle of trying to replace investors. It's very hard work. So a few years ago, we introduced a new model that we call the constrained stock model. And the constrained stock model is that everybody that comes in is locked up for 5 years. And that's another way of kind of saying, look, this definitely isn't an exit. This is a growth strategy. But because we've locked up the equity for 5 years, there's very little liquidity, which means that you always have more buy side than sell side. And we only leak stock into the market when there's more buy side than sell side. And what that has meant is that you're kind of in a situation where you can say to companies, all right, you're joining at this price, you're getting $5 million worth of shares at this price, but we're edging that share price up month on month. And, nobody's going to be dumping the stock in the future, and you've got that. And so that has completely changed the game. Now, the markets hate it. Investment banks hate it. Investor relations hate it, because, the whole industry only makes money when people trade. But actually, there's nothing illegal about it as long as you've got 20 to 25% in public hands. And it's a much more effective way of doing it, because you can then say, look, for the next 5 years, we're just going to build, we're going to add companies, we're going to grow to 50, 100 million in EBIT. We're not worried about what the share price is doing, because we're only leaking a little bit of stock as we need it. Because the share price is going up month on month, it's much easier to do acquisitions. Whereas if you've got a typical small cap volatile stock,
so just to be very clear, I have a business. I'm in this portfolio now. I want to do an acquisition under my business. I can use my stock. I can use debt. I can basically give equity in order to do acquisitions in my specific business itself. Correct?
Yeah. So we will create new stock as long as the deal is accretive in nature. So we're buying at a multiple lower than the multiple we're trading at, which we should be. We're happy to create new stock to do an acquisition. If you wanted to do debt, that would be one of the sort of reserved matters that you would need to get buy-in from the other people around the table. If your stock price is going up steadily, lots of business owners are quite keen to swap for stock that's going up, because it's only upside.
And then from your experience, since you've been doing this a decade now, after 5 years, what is the stock for the average portfolio company you're running? What is the multiple it's actually trading at? And what is the experience from, a certain part? 5 years is a long time, somewhere between 5 to 10 years, I assume. A good predominant number of at 5 years, owners will want to start taking chips off the table.
So look, we haven't been running the constrained stock model for 5 years. We only introduced that really in the last couple of years. And we're pretty comfortable. We can 5 to 10x the original share price. So obviously, the sooner you get into the group, the more upside you have. But also, we are much better now at kind of controlling. So, we know that first liquidity cliff is going to come after 5 years. Now, by the way, that should be a relatively small amount in the whole piece, because you've been adding companies on a regular
throughout
basis.
that 5 year period, right?
Exactly. But because it's coming, you can also have conversations, and we've got quite a lot of family offices and small insurance funds and people that will happily take off-market blocks of stock at a discount, which is a good way of avoiding pushing the share price down as well. So I think a lot of our biggest learnings, we understood inherently kind of how you make this attractive to business owners. And when we did that, we've really spent the last few years figuring out the piece from the investment side to how you protect investors as well and make this work on both sides. And that, you kind of have to go against all conventional wisdom to actually make it work. But that's been the approach that we've taken.
One final question about the model, and I just want to get your view on 2026 and what your plans are. So I'm an owner. I'm used to, I have a million, let's say I have a $3 million EBITDA business. I take typically 60% of that in a year or 50% because I need taxes. How does that actually work in this model with distributions?
When you shift from private to public, there are certain things that change. So obviously, as a private company, you want to minimize your profits for obvious tax reasons. Whereas when you're in the public markets, you're getting paid a multiple of profits, and so you want to maximize your profits. So in one regard, you're kind of losing what we normally do. So most business owners are taking a very low salary and taking distribution tax efficient. So what we do before they come in is kind of normalize that and say, okay, look, you're in a public company now. You need to be earning the salary of a public company director, and hopefully what you're losing in the sort of the tax on maximizing your profit, you're more than making up for in terms of the capital growth and being part of something bigger. And the combination of being able to earn this 3 times your additional EBIT in stock every year, which is significantly more than you would have been taking in dividends. Plus, you've got an appreciating share price. And it's decided by the founders themselves. Like, it's almost perfect corporate governance, because say you've got 20 companies in the group, they're all the majority business owners as well,
and they're deciding the distributions every year. So so clear that because it's just a fact. If I'm used to living off $1 million a year, I'm suddenly given a public salary of 250 or 300,000. That would be fine, but suddenly now I'm at a shortfall with what I've typically been living off of for the last 5 years or 10 years. But I understand that overall, if my company is generating the profit, and the owners can make the decision about distribution. And so that's really, really interesting. Okay. So I know that and I appreciate the time today. I know that I could keep on going for a long time, because to me what you're doing is fascinating and your background is fascinating. What's 2026 look like for you?
So interestingly, we've kind of spent the last 10 years working on this model, and myself and my business partner, Jeremy Harbour, we're quite well known. So we get a lot of deal flow from small businesses that are looking for this. What we're seeing a lot of is actually companies that just want to go public themselves. And we've now got sort of a situation where we can basically do most of the work of an investment bank. So we've got investors that like backing what we do. I think we will probably take between 8 and 12 companies public in 2026 in their own different sectors. And some of them want to grow by acquisition. Some of them are sort of tech plays or whatever else. But we can do it to the point where it doesn't cost them any money anymore. So we will take the risk on the cost, and we take equity in the deals, which aligns our interests with their interests. Because we're running the constrained stock model, we're pretty confident with that. So yeah, I think it's really fun at the moment. We've got a lot of deals coming our way, and a lot of great companies that I think it's sort of been stuck as being too small too small for the sort of the big players, but are perfect for this option. So yeah, we'll be doing that, and then as you and I spoke last time, we've got quite a few sort of auxiliary businesses around. So we, like you mentioned in the intro, I have a company called Veblen Directors, which helps people get their first board seats. And obviously with all these listings, we've got quite a need for well-trained board members. And yeah, we've got capital raising communities.
Oh, that's fascinating. Well. Maybe we can just unpack that for a second. So how does that actually work? And then if someone's a new board member, Is that usually a compensated role with stock and with cash, or how does it actually work?
Yeah. So, well, look, first of all, because I know you have a lot of entrepreneurs listening, there's an interesting stat that there's 330 million businesses in the world. Less than 1% of them have an active functioning board. And yet every single successful company you can think of has an active functioning board. And so most entrepreneurs don't have a board because they think it's going to be expensive and they think a board is going to tell them what they can't do. And as we've already identified, entrepreneurs hate being told what they can't do. And so we have a very different approach, which is I think an advisory board is an absolute essential for any small business. And I always kind of say to entrepreneurs, firstly, get an advisory board. It doesn't need to cost you anything. I learned this lesson about 10 years ago. I had people from Google, I had people from Facebook, from Microsoft sitting on my advisory board. I didn't pay them anything, but they were middle managers who wanted to live vicariously through advising me. And yet I could, honestly, they could have been janitors, but I could trade off the fact that I had Microsoft and Google sitting on my board. And look, one introduction from an advisor can completely change the trajectory of your business. So I'm a huge fan of advisory boards for businesses. And we offer 6 months completely free for companies that want that. But the other thing is I think all entrepreneurs should sit on the boards of at least a couple of other companies. Mm-hmm. And every entrepreneur will say, look, hang on, I'm already 24/7 with my own business. I haven't got time to think about anybody else's. But you learn so much. And you'll see that they've figured out things that you haven't figured out, and you've figured out things that they haven't yet figured out. And it's such a great way, and it kind of gets you out of the weeds and thinking holistically about another business. It's really, really valuable. And so, we have this program called the Veblen Director Program. It's a 3-year program. We start people off on advisory boards or apprentice boards to publicly listed companies where there's no legal risk. But oftentimes it's not particularly well paid, or it might be equity or something like that. But it doesn't really matter. It's about kind of getting you on the board ladder, getting you in the right rooms so you can build those relationships with the key people that are going to be massively important over the next 10 years of your career. So that's kind of the approach we take.
Program focused for entrepreneurs or people that are senior level people at larger corporations?
So it's quite a mix. I think we're probably about 30% entrepreneurs and about 70% middle managers and above. I think our youngest member is 25 and he's now sitting on 2 or 3 boards and fantastic. And then we've got retirees. But the average is probably sort of 40 something and starting to think, hang on, I need to be doing more with my career. And lots of people sort of have this idea, I'll sit on a board at the end of my career, but they don't really know what a board is or how you get on there. And so we're sort of very keen on saying, hey, look, here's a path that can get you on your board seat. And most of our members get their first board seat within a month of joining. And you learn so much more. And I think what was interesting is when I was looking around trying to help people get their first board seats prior to this, all the training that's out there is kind of like the Directors Institute certificates and things like that. It's all based on what is good corporate governance for an S&P 500 company, which might be fascinating to the right person, but it's absolutely irrelevant to 99% of businesses. And in fact, if you tried to apply that to a small business, you would kill them. And so we are very much focused on, how do you get your first board seat, and then how do you add massive amounts of value? And more often than not, it's kind of people in your network, doing introductions to potential clients, being an advocate for the business is just, it's a huge thing. So it's very practical and very, very, very valuable, both for the companies and for the directors themselves.
Yeah, it's interesting because if you're on a board of directors, you got to make sure that there's insurance and you're protected from from board insurance. On the other hand, you're right. Board of advisors, you don't have that legal risk. Now, what I advise companies to do is 2 things. Is I strongly recommend board of advisors, but I also recommend that you cap how long people are on the board of directors. And why is that? as the business grows, you'll often outgrow your board of advisors. And the same people that
Absolutely.
helped you 2 years ago cannot help you now. One might be a short period of time, so I usually cap them at 2 years and tell them that it could be a 1 year gig or 2 years, and then we make a decision and we try to uh, reevaluate and evolve the board. And sometimes people stay on, but most times we move people because I like to set the expectation, because telling someone you're off the board is really tough. But if you have a hard date on it, it really makes it easier to constantly upgrade your board.
So we're now in our fourth year of Veblen, and we recently introduced something that we call Board in the Box, which is a really nice solution. So basically, Board in the Box is any company can apply for it. We will hand pick a board of 4 or 5 advisors for them, and they will work with you for the next 6 months. So it's a 6-month term, and they're going to spend 2 or 3 hours a month with you.
Oh, wow.
And basically their job is to add as much value as possible. So you couldn't imagine letting them go at the end of 6 months. Your job is to extract as much value from them as possible. And look, you might say, look, 1 or 2 of these are great. I really enjoyed working with them. I'd like you to stay on. Or you might say, look, none of you are great, but it allows our members to get that much needed experience and update their profile and potentially sit on the board of a company in an industry they know nothing about, which is useful. And the other thing we noticed as well was when we were doing it before, companies would apply, we would send them sort of 20 great candidates. They didn't really know what they were looking for because they'd never built a board before. And so they would kind of do these interviews, but they didn't really know what they were asking. And they would just end up hiring people like them to sit on the advisory board. And when we kind of put this pick and mix together of random people, it's really interesting. And like, it's proper diversity on the board, not in the, not in the sort of the way that's been misopted, but just focused on like diversity of ideas, people from different industries, people from different countries, different backgrounds, that can really kind of give you a completely fresh way of looking at the business. And it's been super rewarding for those businesses in a way that you kind of probably wouldn't have done if you had selected the people that you think would be right for your business. And then you filter over time, obviously.
That's beautiful. I really like that, love that model, because I know for myself, not only on sitting on a bunch of boards, the value it's given to me, because as you're sitting, you're learning. As you're sharing advice, you're sharpening basically you're sharpening your blade, and so you just become better at what you do. Gives you better perspective. And flip side, having the right advisor can change everything. One phone call from the right advisor, one introduction can change everything. If one of our listeners, entrepreneur, has been approached by another company that is a model similar to yours, Callum, what would you what recommendations, warning, advice would you give them?
Going back to sort of agglomerate.
The conglomerate, correct, the agglomerate.
So people tend to look at what we do and go, it's a roll up. I understand that model. Roll-ups don't have a particularly good success ratio. I mean, you've got Constellation Software up in Canada, which has done it brilliantly. Sweden actually has some really, really good roll-ups, and they're quite big into that play. But the majority of times it's done, what happens is you have somebody with an MBA that takes on a bunch of debt, buys a group of 20 dentists or whatever it is. And because they're the acquiring company, it's all about them and their ego. And so, they rebrand the companies, which, as an entrepreneur, you spent 20 years building up trust in your brand. Suddenly that gets destroyed. The founders often take the money and leave, which, the founders are such an important part of the game. And then the other mistake that we saw happening a lot is the acquiring company needs a fancy head office, and they'll put in an expensive CFO to consolidate the finance, and the expensive CFO needs a PA to talk to, and the PA needs an HR manager to whinge to, and the HR manager needs a travel policy to justify their existence. And suddenly you've got like this massive overhead in the head office, and small businesses are actually run incredibly efficiently because it's the owner's cash.
Right.
And what tends to happen is you kind of have these MBAs or private equity people that think, well, look, you're leaving so much money on the table because, for example, you've got 20 companies, 20 CFOs, right? You only need 3 CFOs. But in a small business, the CFO is typically the most trusted person. And half the companies I speak to, it's the brother-in-law of the founder, or there's some interconnection there. If you fire them, you lose more than just, you might save a few percentage points on salary, but you lose a ton of the understanding. And this is kind of one of the things that we entrepreneurs inherently got about our model, which is we let you keep your team and run things the way that you do. And every company has got Doris, who's absolutely useless, but you can't fire her because she keeps everyone happy. And that it's worth keeping Doris. But somebody with a pure balance sheet mindset doesn't see the value in that, and you kind of end up with all these problems.
Create that friction. So if I'm part of one of your groups, obviously there's a corporate overhead, there's fees for the public in maintaining this entity. So how does it actually get charged? And
So remember that you and the other business owners are the majority owners of the company, and so basically we have an actual board of directors that faces the market, and that's all they do. And then you have all of the founders themselves it's this group, but they're the majority shareholders as well. So they decide how much of the money goes out as a dividend distribution, how much goes on investor relations. And remember, if you're playing our constrained stock model, you save so much money because you don't have to go through all of the hoops of going and doing these road shows and investor relations and putting out expensive, very pretty annual reports, and all of that stuff stops being important, at least for the first sort of 4 years. That you're going to ramp it up in the 5th year. And that saves you so much money. So, but it's you and the other founders make a decision on a vote on how that money gets allocated.
Perfect. Well, I thank you for joining me today and indulging me on my questions. I think your model is fascinating. I'm going to say that it's the next level way of unlocking value and scaling for entrepreneurs. Long-term wise, I see in the DeFi world that there's some changes that will probably be happening where companies are going to be able to be, private companies will be able to trade through Robinhood, but we're many years away from that.
Exactly. Look, I think the model has been around, the public markets model has been around for 400 years. And it's definitely ripe for, there's so many things that could be improved on it that, DeFi can improve on it, but you've got to remember it's a massive industry, and there's a lot of people with very vested interests in keeping things the way they are. So you're right. I think it's still a few years away, but I'm hopeful.
Thank you again. This has been fantastic.
Likewise, I love chatting with people that know the space as well, because it's we can get into the weeds of it.
Going to wrap for today. Thank you for your gracious time, and I look forward to seeing you.
Thank you for tuning into Deal Playbook. If today's episode sparked an idea or gave you an edge, share it, subscribe, or leave a review. Remember, opportunity doesn't wait, it's created. Until next time, keep building, keep scaling, and keep playing to win.